Okay, so good evening everybody. Now before we get started today, just a really quick announcement. I've mentioned it to a few of you already, but tomorrow you're going to get an announcement from me in this subject regarding changes that we're going to implement into the tutorials for the next 2 weeks. Okay, so please be very mindful of that announcement once it comes back. I've written it in quite a lot of detail, so it covers off on exactly what's going to be happening, but please make sure that you check that as soon as possible. Like I said, it'll come out probably tomorrow morning, okay? And it's just a couple of changes that we're going to put in place for the tutorials over the next 2 weeks. And again, the intention behind the changes, and I haven't mentioned this to you all before, is I want you to get a lot of value out of the in-class activities. And because of the quizzes and presentations we've had and the fact that they take the majority of the tutorials, I don't think that that's been done to a level that I want. So we're going to incorporate a catch-up tutorial, ladies and gentlemen. So you're going to have an opportunity to go back through the in-class activities and get some guidance, okay? So be mindful of that announcement. As I said, it'll be coming out tomorrow morning. So let's start off today by picking up on where we left off at the end of last week's lecture, which was on audit sampling. So let's get straight into it. Audit sampling, ladies and gentlemen, the first thing I want everyone to write down is the auditing standard that covers audit sampling, which is ASA 530. Now, I'm going to be making references to this a bit later on, but you do need access to ASA 530 in terms of its coverage of audit sampling. Now, remember what audit sampling was. Everything in a particular account is called the population. So the population is every single item or every single transaction that makes up an account. Now, remember, in audit, it is very rare for us to test the whole population, because it takes time, so it's time consuming, it's expensive, and sometimes given the scenario, it could be absolutely impractical. What do I mean? It is physically impossible to test every single sales transaction at McDonald's, right? So what we often do is we take a sample. Remember, a sample by definition is a smaller subset within the population, a smaller group within that population. Now, what do? We take that sample, we test that sample, and we come up with a conclusion based on the testing. Now, here's the link, ladies and gentlemen. We take those results, we take those conclusions, and we project. Write this down. Project is the word. We project those conclusions onto the whole population. At the end of the day, we want to be making a conclusion on the whole population. We are simply taking a sample because it is more, here's your key word, efficient, right? So we need to be mindful that the final conclusion does relate back to the whole group. And I'll show you how this works as we go on today. Now, I did mention this last week, and the fact is that there are 2 different categories of sampling. We have statistical sampling and we have non-statistical. Now, I just want to introduce you or highlight the key aspects of each. Statistical sampling revolves around one key concept, and that is random. Okay? What it means is the sample is actually selected on a random basis. Ladies and gentlemen, that means every single item in the population has a chance of being selected. Okay? When you select randomly, everything has a chance of being selected. Now, that's going to be different to what I talk about very soon, which is non-statistical. So the key notion with statistical sampling is that the sampling technique used, it results in a random selection of some kind. Now, the other thing is that we often use probability theory, or we often use technology to help us pick a sample based on statistical sampling. Okay, now I'm going to take you through the 3 different methods in just a moment, but the key aspect of this is it does result in a random selection. Non-statistical sampling, however, revolves around a different notion, and the key term there is judgment. With non-statistical sampling, we actually exercise our professional judgment in the selection of the sample. And again, there are 3 methods under that category as well. So first one, random, and we often use some form of technology to help us. Non-statistical, using judgment. Okay, so let's go through each of the methods underneath each category. Statistical sample selection methods, as I noted, there are 3, and the first one, quite rightly, is random selection. Now, as I noted earlier, random selection means every single item has a chance of being selected. Now take that one step further. There's an equal chance of being selected. All right? Now with random selection, we often do see auditors use some form of technology to help them pick a random sample. And you know what? I can give you an example of this that relates to you. In your tutorials, we do in-class presentations. Now, what I do in my classes is I make sure that it actually is random. How? I have all my students in an Excel document and I utilize the random function in Excel. So it actually identifies 5 or 4 random students within that class. Now, like I said, why do I do that? Because the function exists and I can have confidence that it is indeed random. Okay, there's an equal chance of being every single item has an equal chance of being selected. The next the next method under this category is systematic sample selection. Now, what I would like you to write next to this is what I actually call this method. I don't call it statistical, I call it interval selection. Interval selection. Oh, sorry, interval, my bad. My apologies. Interval selection. Now, how this works is we actually select our sample based on a certain interval. Now, how do you do this? Guys, if you bring your attention down to here, I've provided you with the formula. Now, how it works, let me put some numbers with this so you can kind of make a connection for yourself. But essentially what happens in this particular case is we first take the population size. Now, what does that mean? It means that we take the total number of items in the population. So to provide you with context, say we're looking at our sales invoices. Now, we know that there are 10,000, actually, you know what, let's change it. There are 500 sales invoices in this organization. So the population size is 500. We then divide that by what's called the desired sample size. What does that mean? It means how many items I want to pick. So of the 500, say I want to pick 20. So I take 500 and I divide it by 20. Now, what is that? 25. Ladies and gentlemen, here's the link. We then, based on this interval, what it means is we then pick every 25th sales invoice. See what I mean? You're selecting your sample based on this interval. So you pick every 25th invoice. Now remember, something that we've mentioned earlier is usually in organizations, the documents are pre-numbered. So you'll have sales invoice number 1, sales invoice number 2, sales invoice number 3, and so on. So in this case, we know that there's a total of 500. We know our interval is 25. What does that mean? We pick every 25th one. So we pick sales invoice number 25, number 50, number 75, number 100, number 125, and so on and so forth. Now, to add one level of not complexity, but one further level of randomness to it, we don't start at 1. We start at a random point. What do I mean? Say you start at random point 10. So that means you pick invoice number 10, invoice number 35, invoice number 60, and so on and so forth. Okay? So this is you're selecting a sample based on an interval that you have calculated using this using this formula. All right? Now, does that make sense to everyone? Head movement for me? Yeah? Take that same concept and apply it to the next one. It's exactly the same thing, but in this case, you're not focusing on the number of items, you're focusing on the dollar amount. So instead of saying that there are 500 sales invoices, you say that the sales invoices are a total of $10,000. Okay, for example. You then divide that by the 20 sample size that you wanted, and the result of that is 500? Is $500. Now, what does that mean? That means you pick every sales invoice where the 500th dollar lies. So it's exactly the same thing. The difference is with a systematic or interval selection, you're picking it based on the item number, but with monetary unit sampling or dollar unit sampling, you're actually picking it based on the dollar amount. But it's the same concept. Now, for your purposes, this is something I want you to know, but it's not something that I'm really going to get you to apply very much. Okay, now it is something that I'm going to mention a bit later on as well, but in this subject, I'm not going to test you on I'm not going to test you in terms of, I'm not going to ask you to calculate a sample. What I am going to do is to ask you, given this situation, would you pick a bigger or smaller sample? But I'm not going to get you to do sample size calculations, okay? So you can know that. Make that note. I might ask you to do intervals, like calculate the interval, but I'm not going to get you to calculate sample sizes, all right? The reason for that is every audit firm does it differently. So there's no point me teaching you a particular way, only for that way not to apply if you're actually going to go into industry with it, all right? So that's the rationale there. So again, just to recap, under the statistical sampling category, these are the three methods that we can utilise. The second one, which is non-statistical sampling category, again, there are three. Now, the first one is called haphazard sample selection. Ladies and gentlemen, the way that I explain this, listen very carefully, it is the human equivalent of random. It's the human equivalent of random. Now, allow me to elaborate on that. What do I mean? This is where we try, as humans, we try to be random, but because we're human, we often aren't random. Let me explain this to you using an example. So, as I said earlier, I also teach postgraduate audit as well at UTS. So I actually asked my class this question. I said, give me 4 volunteers, so 4 people got up, and I gave them all the exact same scenario. And the scenario was, okay, I need you to imagine that you have 3 juggling balls, okay? Now, every single one of them, I said, now position these 3 balls in the space in front of you. The first student said, okay, well, I've got the 3 balls. I'm going to put them into a triangle formation. So 1 ball here, 1 ball here, 1 ball here. The second student said, okay, I'm going to do something similar, but I'm going to do it the opposite way. So it was an upside down triangle. So 1 on the left, 1 on the right, 1 on the bottom middle. Third student said, I'm going to be different. I'll put it in a line. 1 over here, 1 over here, 1 over here. Fourth student kind of sat there for a little while and then said, okay, I'll do this way. So 1 up here, 1 in the middle, and 1 down below. Now, did anyone notice a similarity in all 4 of those configurations? Sorry? Not really, because the triangle didn't have a middle one, but there was the same with the other 2. Did you notice anything? Were they close together or were they spread apart? How apart were they? Were they equally spaced apart? Yeah, ladies and gentlemen, that's not random. That's a pattern. Here's the thing. Why do I call that the human equivalent of random? Because our brains, the human brain is wired to put things into patterns. So when we're asked to be random, you know what we often do? We equally space it apart. Because to us, we're like, yeah, that's random. That's not random, that's a pattern, right? So this is why I call it the human equivalent of random. This haphazard selection is when we're trying to pick things randomly, but often because of the way our brains work, we often end up picking in a certain pattern, right? But that's haphazard. Here's the key. The difference between this and random, you often use a piece of technology to help you, like Excel, and you know it's actually random. Here, you're basing it on yourself. Now, let me just add one more thing to it. Most of you would have done business statistics. Let me show you what random would actually look like. Random will include things that are close together and things that are spread apart. That's random. Do you see the difference? Humans, we often don't do that. We often just spread it apart. And again, that's a pattern. So it goes against that notion of it actually being random, all right? So that's haphazard, the human equivalent of random. And by the way, here's the confirmation. We select items without any conscious bias. Here's the thing, we do have bias because we put it in a pattern of some kind, but we're just not aware of it. Again, humans, okay? So that's the first one. The second one is block selection. Now, for me to explain this to you, I'll do a timeline so it makes a bit more sense. But it says here, this is block sample selection is often when we select a sequence of items. What does that mean? We select items in a block formation. So we select everything, for example, within a particular time period. So if you look at the timeline I've drawn on the right-hand side, an example of block selection, now pay attention to what I'm drawing. An example of block selection is if we select all the sales transactions in the last week of the financial year, And we also select all of the sales transactions in the first week of the next financial year. That's block sampling. Why? You've literally selected everything within a certain period of time. That's block, because you're following the sequence of the items. Now, does anyone know if we did that, so if we took all the transactions in the last week of the financial year and the first week of the next financial year, what could we be testing? What assertion could we be testing? Ladies and gentlemen, well done. Cut off, and that is your link. Block selection is often only used when you're doing cut-off testing. Remember what cut-off testing is. It's when you're checking the transactions that happened around year end, and you're, here's your key, vouching it back to supporting documentation to make sure it was actually recorded in the right period, which remember is the definition of cut-off, making sure a transaction was recorded in the correct accounting period. So this is a test that we often do perform in audit because it's checking that the transactions that are more, susceptible to being recorded in the wrong period, we're checking that they were actually correct. All right? And that's called cut-off testing. We often do it for sales and expenses as well. Now, the final one here is direct judgmental sample selection. What does that mean? You are directly using your judgment and you know it. So one way that we do this is we often pick some form of criteria and then we pick a sample based on it. Now, let me give you an example here. If I was testing, for example, I was testing non-current assets and I decide, well, I want to focus on the non-current assets that are high value. So I say, I'm going to pick all the non-current assets above $1 million. Ladies and gentlemen, that's why we're sitting in this category. We are selecting a particular criteria based on our judgment, and we are selecting our sample based on that criteria. So I'm going to pick all the non-current assets above $1 million. Okay? And that's directly using your judgment. So these are the three methods that fall under non-statistical sampling. And as you can see, in all of them, they're not really random. Okay? And the first one, it's not really random, it's the human equivalent of random. Now, there's one more element or one more concept I would like you all to become familiar with, and that is the concept of stratification. Now, stratification is, the best way for me to explain it to you is visually. So coming up to the screen, stratification is when you take the whole population and you break it down into smaller groups. So here, here, and here. Instead of looking at the whole population, you break it down into smaller groups. Ladies and gentlemen, the best example of that is often what we do with accounts receivable. Now look at the table that I've drawn up for you. With accounts receivable, we often don't focus on just the total. So instead of looking at accounts receivable from the perspective of it's $1 million, we break it down into smaller groups. Now, a way that we do that, and for accounts receivable this is quite relevant, is we actually stratify or we break it down based on the number of days it has been overdue. So remember, accounts receivable is money owed to the business by customers. So we then stratify, we break it down based on how long it has been overdue. So as you can see, there's $350,000 that's overdue between 0 and 30 days. Then 31 and 60 days, 61 and 90 days, and then above 91 days. So in total, you get to the 1 million, but instead of looking at it from a total perspective, you break it down into smaller groups. Now here's the key. Once you break it down into smaller groups, as the case here, you treat, listen very carefully, you treat each group separately. You essentially treat every group as its own population. Why is that important? Because what it means is that you can actually apply a different sampling technique to each one. So the first one, you can apply random selection. The second one, you can apply interval selection. Third one, you can apply judgmental selection. So you essentially treat each one then separately. Now, why would you want to do that? Ladies and gentlemen, look at the 4 categories you've got up. Look at these 4. Which one of these do you think it has the greatest risk of material misstatement? Why? Not cut off. Why do you think it's the last one? 91 days plus. Say it again?
Is it because basically it's been there the longest, so like
Yep, so what's the risk? If it's been overdue by more than 3 months, what's the risk? Are they going to pay you or not pay you? That's the risk. And here's the thing. Why do we care? Because let me rephrase. We care as auditors because remember, a company should only include accounts receivable that they think they're going to collect. If there's a risk that they can't, where does it go? Bad debt. So we want to make sure that the amount of money that is sitting in this category is actually true. Here's the key, valuation allocation, right? So we want to be looking at this. So in this particular case, if we think that's the highest risk, guys, we might actually just go and test the whole population. And we might do sampling for the rest. So we want to break it up so we can treat each group separately and apply the techniques and the testing that we need to each one, given the risk, okay? So stratification, I must say, it is not a sampling method itself. It is the process by which we break down the population into smaller groups and then we actually look at the groups as its own population. That's the key, okay? But that's another important concept for you to know. So what are the steps in audit sampling? Ladies and gentlemen, step 1 is you must design your audit procedure. What is the test that you are performing? Is it a controls test? Is it a substantive test? You need to design what that procedure is going to be. Ladies and gentlemen, direct flow on from that is you need to identify the population from which you're going to pick your sample. Let me give you a good example to bring this together. Let's talk about one particular procedure, vouching, okay? Vouching. And we'll do consistency, vouch sales. Now, let me ask you a question. Let's see how many of you are on the ball. Vouching sales, are we going forwards or are we going backwards? Where are you starting? The records which are? Journals. Excellent. Ladies and gentlemen, why do I do that? The population is your starting point. Whatever your procedure is, wherever you're starting your procedure, that's your population. So when you're vouching, remember, you're going backwards, right? You start at the end. What's at the end? The journal. That's your population. You pick a sample of the journals and you vouch them back. Let's change that up. If you were doing tracing, you're starting at the beginning. If you were starting at the sales orders, that's your population. You pick a sample of your sales orders and you trace it through to the end, right? Here's the thing though. If you're doing tracing, your starting point might be different. It doesn't have to be the sales orders. It can be the delivery notes. You start at the delivery notes, so that's your population. You pick a sample of the delivery notes and you trace it through. So the key concept I'm trying to make clear for you is your population, ladies and gentlemen, it's your starting point. And that is why it is directly starting point. It is directly related to your test. Once you design your test, the very beginning of your test, where you are starting, that's your population. Once you have your population, then you pick your sample. Your sample comes from that population, right? Now, before I go anywhere, are we okay with that? Head movement for me? Yeah? Guys in the back, make sense? Awesome. Now, when you pick your sample, it's at that point that you ask the question, which method should I use to pick my sample? Should I do random selection? Should I do systematic selection? Should I do judgmental selection? That's the point that you make that decision. Then, once you've got your sample, you conduct your test. You go ahead, you conduct your procedure, and you evaluate your results, okay? Now, it's the evaluation process I'm about to take you through in the next 2 slides. How do you evaluate your results? Ladies and gentlemen, the process that you follow in evaluating your results is slightly different if it's a controls test versus a substantive test. Now, I'm going to say one more thing. The next 2 slides that we're about to go through are a fantastic reference point for you all. I've tried to make it as clear as possible and I will elaborate as we go along, but please make sure that you are using those to gain your to solidify your understanding. So the first one is controls testing. Now, there's a couple of terminology that I need you to be very mindful of and aware of now before we go further. Controls testing, you are testing controls. You are testing whether the controls are operating effectively. They're doing what they are supposed to be doing. First concept I need everyone to highlight or underline is the term deviation. Deviation, a control deviation. What is a control deviation? It is any instance, listen very carefully, it's any instance where the control doesn't work. It's any instance where the control has not done what it was supposed to. Now, to give you a further understanding of this, allow me to provide an example. So say we are testing a particular document. And of that document, we are testing that the correct manager or the manager has signed off or approved that document. In this test, that's what we're looking for. We're looking for the signature. What that means is any item, any document that we look at that does not have the signature, that's a deviation. A deviation is any instance where the control didn't work. So you need to identify, as part of step 1, you need to identify in this test what would be a deviation. Here's a good way of thinking about it. What are you looking for? If that thing is not there, it's a deviation. All right? I'm looking for the signature. If it's not there, that's a deviation. Now, again, you haven't started the testing yet. What do? Step 2, you need to set what is called a tolerable deviation rate. What does that mean? Ladies and gentlemen, it is you must determine what rate of deviation are you willing to tolerate or accept. So given the testing I'm about to do, what percentage am I willing to let go or accept of the control not working? Now let's go through this process and we'll do some examples. So at this point, we're looking at a document, we're looking for the manager's signature. Step 2, we need to decide, well, what's my tolerable deviation rate? 10%. I'm willing to tolerate, for example, that 10% of instances that I check, the signature's not there. I'm willing to tolerate that or accept that before it becomes an issue. Now, once you have those 2 elements, step 3, you do your testing. Okay? Step 3, you go ahead, you conduct the test the way you had planned to conduct the test. You follow the procedure that you had designed. Now, once you do this, once you conduct the test, you will then identify any deviations. Now, there might be 0 deviations. It might be a great control. But there might be instances where the control didn't work. So let's put some numbers to it. We check 10. We check 10 of these documents. Okay, so my sample size was 10. Out of the 10 that I select and I test, I find 3 instances where they didn't work. So 3 deviations. Okay? Then you go to step 4. Now you've completed your testing. You've identified all the instances where it didn't work. You need to now calculate what the actual rate of deviation was. Given these statistics that you see, what's my actual rate of deviation? Good, 30%. Ladies and gentlemen, you then bring it home. The first question you must ask is, what was the source of the issue? Was it a one-off or was it a regular or systematic issue? Now that's really important because if it was one-off, it shouldn't have happened again. If it's systematic, it's happened throughout the entire population or throughout the entire year. That's an even bigger problem, right? So we need to find what's the source of this issue. We can talk to management, or here's another thing we can do, pick another sample. Do the test again. See what the results are. Now on that note, this is important. If the auditor decides, you know what, just to get a bit more comfort, I'm going to pick another sample and do this again. So go back up. We pick another sample, we pick another 10. In the 10 that we pick, the second time around, we find 2 deviations. So 2 instances where the signature wasn't there. Ladies and gentlemen, do you think that we disregard the first test? Yes or no? Do you think we just base it on the second test? Yes or no? What do you think we do? Very good. You combine. You'd never disregard a previous test because it was still testing the population, right? So what you do, you combine them. So essentially here, we're now looking at a situation where there were 5 deviations over 20, okay? Now, coming back to it, so pretend we didn't do the second test, so we keep it as the 30 deviation percentage. What you do at the end is you compare them. You compare your actual deviation rate, which in this case is 30%, to your tolerable rate, which we had as 10%. Now, in this situation, we've got 30%, as we noted, was not working, over the 10% that we were willing to tolerate. Now, do you think that this is an issue? Do you think this is an issue? Yes or no? Here's how it works. Here's your story. Yes, it's an issue because it's the number of deviations, the rate of deviations has far exceeded what we were willing to tolerate. So what happens? You adjust your control risk. You go back. You now know for a fact that the control failed. It does not operate the way it was supposed to. So what happens? You adjust control risk upwards. So if it was low, it now becomes either medium or high based on the judgment of the auditor. If it was medium, it now becomes high. Now here's a question I always get. What about if it's high? Well, if it was high, you wouldn't have done this in the first place. Remember? Okay? So we adjust control risk up. What does that mean? Detection risk must now come down. How do we do that? We shift. We shift our strategy to more substantive testing. And that's the story. So how do we, and we've spoken about this before, how do we know when to shift? You shift when the results are like this. You get to your testing, you compare your actual deviation rate to that you were willing to tolerate, and then you actually adjust your control risk and shift your approach accordingly. Okay, now here's the thing. If we had a situation where the actual deviation rate was less than the tolerable, you're good. No issues. Okay? But it's only when it's higher that you need to go back and adjust. Now again, this was controls testing. The term deviation is specific to controls testing. Please be very mindful of that. Okay? So, the next time we do this, yep, is that a hand?
So is that deviation rate there?
Sorry? At the bottom, that's detection risk. So when control risk goes up, detection risk comes down. Okay? Now, next one, let's talk about this. For substantive testing, here's the difference. Ladies and gentlemen, I'm going to say this one more time. The term deviation is linked to controls. The term misstatement is linked to substantive testing. Why? Ladies and gentlemen, you've got to remember, substantive testing is the one that focuses on the dollar amount. So if you find that the dollar amount is incorrect, what is that called? That's called a misstatement, right? So the term misstatement comes through only in the testing of substantive nature, all right? So the first element is misstatement. Now remember, a misstatement is when the amount that it should have been is different to the amount that they have recorded. Let me give you an example. Come over here. So say that the audited value means the value we think is true is $90, right? We think it should be $90. We look at the client's records and they've recorded it as $100. Ladies and gentlemen, what is the misstatement? What is it? It's not a trick question. What is it? 10. Why did I ask you that? Because so many times people think it's 90 or 100. It's not. The misstatement's the difference, okay? They've recorded as 100. They should have recorded it as 90. What's the misstatement? The $10 difference, okay? Now, again, just like with controls testing, you need to set a tolerable level of, in this case, misstatement. So not deviation rate, but tolerable level of misstatement. Now, what is that? It's the maximum amount we're willing to accept as misstatement. Listen to me one more time. What did I just say? I said it's the maximum amount of misstatement I'm willing to accept. Ladies and gentlemen, does that sound familiar? What is that? Starts with an M. It's the maximum amount of misstatement we're willing to accept. What is it? Ladies and gentlemen, that's materiality. It's back. All right, materiality. We have a materiality threshold for this test. Right? It's our reference point. So if the result of this test comes up to be a number above it, material misstatement. If it's a number below, not material. Okay? So you need to have that reference point to determine if the issue is indeed material or not. So again, you come up with that materiality number, that threshold. You then go ahead and you perform your test the way it was designed, and you identify any misstatements along the way. Ladies and gentlemen, here's when the term comes in, projection. Based on the misstatement you find in your sample, you must then project that misstatement onto the whole population. How do you do it? Here's your formula. You take your misstatement amount, you divide it by the value of the sample that you tested, you then multiply it to the value of the population. Why do you do this? Because you're assuming that any issue that you found in your sample is present in the whole population. So you take that and you project. Another word is you infer. But projected is the key term that we use, okay? And this is the formula you use to do it. I'm going to give you an example in just a moment. Now, once you do that, evaluation step, first question, same as last time. What was the source of the issue? Was it a one-off or was it systematic? One-off. One person made a mistake. They put it in as 100 when they should have put it in as 90. Systematic. Remember the example I told you, I think it was a few weeks ago now, where the system was recording the invoice totals, each invoice total being 3 cents off, but it was every single one? That's systematic. That's the bigger problem. Because if it's happening over every single item, the chances are it's actually a much bigger misstatement. Do you have a question? Yep.
Would it be the same as like if it's being recorded without GST?
Yeah. Yeah, because then the number's wrong. Yeah. She said, would it be the same if it was being recorded without GST when it should be recorded with? Yes. Okay. So things like that. Now, so we do that, and again, we have the possibility of taking another sample and doing the test again. But guys, key rule still stays the same. You combine your results. You never disregard results, okay? Because you need to combine them. You add to them every time. So when you get to that final, I guess, part of the process, you compare. You take your projected misstatement, the total misstatement you think exists in the population, and you compare it to the tolerable amount you had, which was your materiality number. If it's higher, it's material. If it was lower, it's not material. Now, here's the final piece of the puzzle. Ladies and gentlemen, if it's a material misstatement, we tell them. We say, hey guys, we found an issue. It's significant. We need you to fix it. Now, we never use the term fix. The term that we use is you need to adjust. You need to make the corrections to the accounts that are impacted. Ladies and gentlemen, here's my question to you. Do they have to? Can we force them to make the adjustment that's needed? Yes or no? No. Here's the thing though. We have one stick. It's called the audit report. If they don't make the adjustment, what's there? Material misstatement. What does that result in? A modified audit report. Okay? So we don't force them, but we say, well, if you don't, there's material misstatement which impacts on the audit report that we ultimately give. Okay? So that's a bit of an incentive. In saying that, there have been instances where this has happened and they still turned around and said, I'm still not going to do it. Give me a modified report. Okay? Never underestimate the power of ego in business. Okay? But again, we've got that stick, but we can't force them to make any adjustments. It's up to management. So to give you a very quick example of this, if the misstatements that were found were $250,000 and that was taken from a sample of 2 million, you then project that onto the population of 5 million and that would give you a projected misstatement of $625,000. Now, what do you do to that? You compare that to materiality. That will determine if it is indeed material or not and what needs to happen according to that. Okay, so it's pretty straightforward. It's a very simple formula. And again, I just want you to practice it. Now, there's one extra level of complexity. And that comes about when there's stratification. Remember, the breaking up of the population into smaller groups. So in this case, as I said to you earlier, when you break up the population into smaller groups, each of those groups is treated as its own population. What does that mean? You need to conduct the projection for each group. Okay, so you would conduct it for this one, get a number. Conduct it here, get a number. Conduct it here, get a number. You then add all of these figures together to find the total projected misstatement for the account, which in this case is accounts receivable. Now, I'm not going to go through calculations here. This is good practice for you. But in order to give you a check, when you add up your numbers, you should be getting this figure here. Okay? So please make sure you just give it a go. It's good practice for you, and you should end up at that number when you round. Now, there's one more thing I want to mention at this point, and that is this. Ladies and gentlemen, I'm going to give you a scenario. An auditor goes in and conducts some testing, and they look at 2 of these groups. So let's say group number 1, group number 2. In the first group, they find that there has been an overstatement of $100, right? So the business has recorded $100 more than they should have. In the second group, same situation, but in opposite. They have understated by $100. So in the first group, overstatement by 100. Second group, understatement of 100. Ladies and gentlemen, do you think those 2 net off if it's in the same group? Let's take a vote. And just vote. It's not accessible. You'll be fine. But let's just see how we're thinking. So raise your hand if you think they net off, because it's 100 over, 100 under. Do they just net off? They're in the same account. One person. 2 people. All right, raise your hand if you think they don't. Wow, let's do that again and everyone has to vote, okay? Just do it. Come on, get involved in this. You do learn better. So raise your hand if you think that they net off. Well done. Not succumbing to peer pressure. Good job. Who thinks that they don't net off? Raise your hand. Straight up. It's good exercise for you. It stretches your arm. Raise your hand if you think it's true. Ladies and gentlemen, very well done. We take what is called absolute values. What does that mean? The overstatement or understatement doesn't matter. Okay, write that down. In the situation I just gave you, in that situation, you know what the misstatement would be? $200. Okay? The over and the under don't matter because it's still wrong. It's still wrong. It doesn't matter if it was over and that's why it was wrong, or if it was under and that's why it was wrong. It's still wrong. You can't net them off. So please be mindful, and if you want, you can write this down. We take what's called absolute values, which means the negatives and the positives don't count. You all add them together. So please be very mindful of that. Do not net off misstatements. Now, depending on the test that you're performing, what you're focusing on from a sample perspective can be different, and often is. So let me give you an example. When you're doing tests of control, you want to pick and you want to test the controls over the entire year. So your sample will be taken throughout the entire year. Why? You want to make sure the control's working the whole time. You want to be able to rely on the controls for the whole year. So you will take a sample from the whole year, okay? Now that's different to this category. When you do a test of details of balances, here's the key, the term balances. You're focusing on what the closing balance is of that account. As a result, the sample that you take and the testing that you do focuses on the number or the balance at year end. Not at the beginning of the year, not in the middle of the year, but at year end. And you want to gain comfort that that number is indeed correct. Guys, this is why we do confirmations. We reach out to the bank and we say, is it true that the business has $1 million in their bank account as at the 30th of June? Because the test of details of balances is focused on the final number, okay? That is different to test of transactions. Test of transactions, remember that's your debits and your credits throughout the year. You want to check them throughout the year, okay? Because it's those transactions that make up the total balance. Finally, analytical procedures. Ladies and gentlemen, there is no sampling involved with analytical procedures. Remember what that is. You're getting all the financial information and all you're doing is you're calculating. You're calculating your trend analysis, your ratios, and you're interpreting them. There is no sampling involved there. Okay? So this is just showing you the links. Now, which sampling methods do I use? Well, it depends on, actually no, let me take you through these ones. The first one, and I mentioned this earlier, the most commonly used sampling method is, ladies and gentlemen, haphazard. It's the random haphazard. It's the human equivalent of random, right? We often want to be random, but we don't want to use technology to get there. So we just pick based on what we're doing, and that's haphazard. Now, what's the most appropriate for testing across the entire year? Ladies and gentlemen, random. Okay? That's the most effective one, most appropriate one. But again, your options are pretty open. So you could have even said haphazard there if you liked. Okay? But random is often the best because it means everything had an equal chance of being selected. Oh, I'm going to push this one back to you guys. Which one's the most appropriate if you're testing cutoff? Block. Well done. And finally, what do you do when you're trying to treat each group separately or you're trying to investigate subgroups in a different manner? Ladies and gentlemen, you stratify. You break up the group, stratify. You break up the group into smaller subpopulations and you treat them separately, okay? Or you treat them as their own population. So the process is you stratify and then you go ahead and you treat each group as its own. Now, as I said earlier, I will not test you on your ability to calculate a sample size because that's something that you would do differently if you're in a different audit firm. So there's no point in us doing that for you. But here's the thing I can and I might and I probably will test you on. And that is I'll give you a factor, I'll give you a situation and I will ask you, in this situation, would you pick a bigger sample or would you pick a smaller sample? Would you increase your sample size or would you decrease your sample size? Now, I've got good news, ladies and gentlemen. As I noted earlier, ASA 530 is the auditing standard that deals with sampling. If you go to the back of ASA 530 and you go to Appendix 2, there's a great table. And what that table shows you is based on a bunch of different factors, what the effect is on the sample size, as you can see on the board, and it also explains why. Okay, so for example, we'll do a quick one. Here we go. An increase in the auditor's desired level of assurance from the controls testing. So if we want to be more confident in the results of our controls testing, ladies and gentlemen, we'd pick a bigger sample. A lot of these, as you sit down and go through it, you'll realise it makes a lot of logical sense. But as I said, in the Appendix 2, there is a third column, and it's an explanation column. Now, what I'm going to say just once, refer to this. Refer to it. It's a good reference point to have. And Appendix 2, it specifically deals with tests of control, whereby Appendix 3 deals with substantive testing, which is the next slide. So this one's tests of detail, which is substantive, and that's Appendix 3. So again, there are numerous factors. You need to be able to identify or determine what the effect of those factors would be on your sample size in terms of would it be bigger or smaller, and also the ability to explain why. Now, very quickly, here we go. If there's an increase in the tolerable misstatement level, so if we are willing to accept a higher level of misstatement, that would actually translate into a smaller sample size, okay? But here's the other thing. If there's an increase in the assessed risk of material misstatement, so we think there's a higher risk of issue, we take a bigger sample. So as you go through this, and I do urge you all, just sit down for 10-15 minutes and go through this in the appendices, it's quite logical. But again, I'm not going to test you on your ability to calculate. I'm going to test you on your ability to look at a situation and determine what the effect of that would be on your sampling. Okay? So please be mindful of that. Now, the final thing to touch on here is, well, when do you actually look at the whole population? Right? Believe it or not, there are situations when we look at the whole population. Now, technically, that's not sampling. Sampling is by definition when you test less than 100% of the population. So if you're testing the whole group, you're not sampling, you're testing the whole group. Now, there are situations where it happens. First one, where there is an account that is extremely risky. Remember, the higher the risk, the more sampling you'd want to do, to the point that if it's really high risk, you want to test the whole group. Okay? Makes logical sense. Another situation could be if you're dealing with an account and that account is made up of a small number of transactions and each of those transactions is high value. Now, here's the thing. Let me ask you a question. Putting all audit aside for a second, this always happens around this time, doesn't it? Looking at a situation, let me propose this to you. In which situation would you be more confident that your conclusion was accurate? So would you be more confident that your conclusion is accurate if you tested the whole population or a sample? What do you think? Pretty logical, right? Ladies and gentlemen, what am I getting to? Whenever you can test the whole population, you do. Why? Because then your results are more accurate. Why do we take a sample? Because it's more efficient. Okay, but if you have a situation like this one where, for example, the total of the account is $1 million and it's made up of 4 items, just go and test the 4 items. That way you cover off on the whole thing and you know that you're accurate in terms of your conclusion. Where you can go and test the whole population, you do, but remember, the overarching objective that we have as auditors is we want to be efficient. Okay, we only have a certain amount of time to conduct an audit, so we want to be efficient in that time and be effective in the procedures that we do. Now, one other area where we might test the whole population is when it's material, when it's significant by its nature. Remember, that's qualitatively material. What are those situations? When you think there's fraud, when there are related party transactions, we test every single related party transaction because of the risk associated with it. We look at the remuneration of executives and we also look at intangibles. Why? Because there's a great deal of judgment involved with intangibles, particularly goodwill, right? and brands and things like that. So in these particular areas, because of the nature of the account, we often do take the whole population and test it to gain that comfort, okay? But it's often, we do try to take samples where we can because, again, it's efficient. Now then, let's move on to the next bit, which is audit evidence. We've talked about audit evidence before, and when we did, we noted that the standard, the auditing standard that deals with audit evidence is ASA 500. Now, what does ASA 500 say? Ladies and gentlemen, looking at that last part of the paragraph, we as auditors must obtain sufficient appropriate audit evidence. What does that mean? Sufficiency. It's a measure of quantity. We must collect enough audit evidence. Appropriateness, it is a measure of quality. We must, let me write that down. We must obtain reliable or good quality evidence. Bring it together. We must make sure that as part of our audit and all the procedures that we conduct, we collect enough good quality and reliable audit evidence to support our opinion. Okay, so you're bringing it home. So everything you do, you need to ultimately make sure you tick off on both of these in terms of the evidence that you collect. All right. Now remember, we talked about this before. There are certain types of evidence that are more reliable. Things like confirmations that come from third parties, that's more reliable because the client's not involved. But you've got to be mindful of those. So please do go back to when we discussed audit evidence to remind yourself of those particular characteristics. Audit procedures, ladies and gentlemen, these terms that you see on the screen right now, these should be imprinted in your brain. Okay, if they haven't been already, make sure that is the case by the next 3 weeks, 3 to 4 weeks. These are your procedures. Every time you design a test, and by the way, you will be designing tests in your final exam, you need to use these terminology because this is the correct terminology. We've gone through these in detail. I urge you all to please revisit this if you're not 100% comfortable in terms of your knowledge because these are really important. Now, here's the other piece of the puzzle. You need to be practicing and being able to link the procedure to the assertion. Which procedure helps me with what assertion? For example, if we are physically examining an asset, ladies and gentlemen, if we're physically looking at it, which assertion does that give us comfort over? Existence, absolutely. Well done, right? It's not that hard, right? Just sit down, think about it logically. Then you've got confirmations. Remember, that's when we ask or confirm things with third parties. Is it true that they have $1 million in their bank account, for example? We inspect documents. Now, one thing I will say is that this one, inspection of documents, does link to vouching and tracing a little bit. The reason is when you do vouching and when you do tracing, you're going forward or backwards in the process, you're inspecting documents along the way. So you can bring those two elements together. But remember, you need to use the correct terminology. You don't say look at, you say inspect, right? Why do I keep emphasizing this? Because this is how you're going to be marked, okay? This is how you're going to be marked. And in addition to this, it's not just about using the right terminology, it's about the detail. It's about the detail of how you describe the test, exactly what is being done. Remember the rule from last week, and it comes through in a couple of slides. You need to be so detailed and so specific that anyone can read your procedure and know exactly what to do. Here's the thing, think about it this way. How would you describe it to your friend if you were telling them what to do and you didn't want them to get into trouble with the manager? Go to that level of detail, all right? Exactly what are you looking for on the documents? Which documents are you looking at? What's the name of the documents? Be detailed. Observation, you don't say watch them do this, you say observe them carry out this particular activity. Whether it's preparing the bank reconciliation or opening up the mail, whatever it is, doing a stock take, anything like that. Inquiries with the client, asking the client questions. Recalculating something mathematically. Now, ladies and gentlemen, if you recalculate something, it could be recalculating the value of the sales invoice. It could be recalculating depreciation, right? If you are recalculating, which assertions are you gaining comfort over? Accuracy, good. Anything else? Well done. Ladies and gentlemen, it's not that difficult, okay? There are natural links between your procedures and assertions, but in saying that, it depends on what you're looking for. It depends on the specifics of the test, because here's the thing. When you do vouching and you do tracing, right? If you're looking at the dollar amount as you do that, then you're looking at accuracy and valuation and allocation, okay? But if you're just doing it to make sure the documents are there, then it's occurrence and completeness and existence. So it really depends on what are you looking for. And here's the thing, guys, there's no one table that I can just give you and it has all the answers, because it just depends on the situation. You need to have the understanding of how do I use these procedures and when can I use these procedures? You know what? You're only going to develop that by practicing. And I've actually provided a table at the end of today's slides that I'm hoping can hopefully help you in terms of preparing for this understanding. And there's also analytical procedures, which is your ratios and your trends and things like that. Please know this. This is very, very, very critical. Okay? Now, as we noted last week, there are 4 rules that you need to comply with when designing audit procedures. It's the same rules we went through last week. As I said, use the correct terminology. The slide that we just had preceding this, they're the terminology you need to be using. You need to use the client-specific terminology. Whatever they call a document, you call a document, okay? If they call it a dispatch note, you call it a dispatch note. If they call it a sales invoice, you call it a sales invoice. Speak their language. Now, the good news about this one is that it'll be given to you in the scenario anyway. So you don't really have to make it up, okay? So the key one here is this. Be specific. We've covered this. You need to be as detailed as possible so anyone can follow your instructions. Finally, we've started talking about this, the procedure. Make sure it matches the assertion. Make sure your procedure matches what you're trying to achieve. Ladies and gentlemen, recalculation as a procedure is not going to help you for determining if an asset exists. Okay? You need to naturally start seeing the links between assertions and procedures. That's how you're going to prepare yourself, because here's the thing. It's not about having really great notes. It's about understanding the logic. And it's actually not that complicated. If you sit down and you just think about it, you will get there. All right? And I'm giving you as many examples along the way to assist you. Guys, just one more thing. I was going to mention this later. I'll mention it now. I've got your back until the very end. I've got 4 hours of consultation that I've put aside for you every single week. If you need help, if you're struggling, guys, we only have 3 more classes after this. If you're struggling, talk to me. Let me help you. I don't know if you're okay or not until you talk to me about it. So please don't think you're on your own. If you're struggling, please do let me know. I hope that's not the case. But you got 3 weeks after this one. Okay? So please just be mindful. All right, now something we have talked about again prior to this is audit programs. We develop an audit program for every single cycle. We've spoken about this before. Each program will have I'll do this in yellow, what procedures and what testing is going to be performed. Is it what types and what amount of controls testing are you going to do? What types and what amount of substantive testing are you going to do? Who is going to conduct the procedures? When are they going to conduct the procedures? Ladies and gentlemen, we have a very restricted time frame when it comes to audits. Once the financial year ends, we often only have really a maximum of 2 months to get everything done. Now, there's a lot that we need to do. Remember, at the end of an audit, we must have gained comfort over every single account and every single assertion for each of those accounts. There's a lot to do. So we have to make sure that we are organising ourselves from a time perspective very well to make sure we are effective and efficient. How? How is the testing going to be conducted? If it's vouching, exactly what are you looking at and what are you looking for? If it's tracing, where are you starting? This is the thing I want to be very mindful of with you all. Guys, when you do tracing, when you start at the beginning of the process and you trace your way to the end, where you start at the beginning of that process is up to you. You can start at the sales invoice, or you can start before that, the delivery document, or you can start at the very beginning, which is the sales order. Where you start is up to you, okay? I don't want you to think that there's a restriction, or there's a limitation, or there's an expectation that you do exactly this. Be creative. You know what? I don't like that. Don't be creative. Just think logically, okay? Think logically. And on that note, I will say one thing. I've said this to you before. Guys, in this subject, there's often, very rarely, one correct answer. You can get a correct answer by doing it a different way to the person next to you. So please be mindful of that. It's a different type of thinking here. It's a way of thinking that we're trying to develop in you. So for example, with the getting the right dollar amount, you can do that through recalculation. You can also do that through vouching, right? If you're looking at the dollar amount throughout the process. So there's different ways that you can gain assurance for the same thing. So just be mindful of that. What and how much evidence are you going to collect? Remember, at the end of the day, you want there to be enough evidence, but you also want it to be reliable evidence. Okay? So, just doing a bit of a recap, once you decide to do a predominantly substantive-based approach, what that means is you're going to do mainly substantive testing with very limited or no controls testing, okay? But when you decide to do a controls-based approach, remember, you would have only made that decision because control risk was assessed as what? When do you do controls testing? Low or good? If it was high, you wouldn't have done it. If it was high, you would have pursued the substantive approach and done limited or zero controls testing. So you would go ahead and conduct the controls testing. Remember, the key here is you would go ahead and conduct controls testing to answer one very important question. Do the controls operate the way they're supposed to? Do the controls do what they are supposed to? Here's the language. Do they operate effectively? Do they operate the way they were designed to operate? If the answer to that question is yes, you limit the amount of substantive testing you do. If the answer to that question is actually no, it doesn't, then that's when you shift your approach and you do more substantive testing to gain that comfort. Here's the thing, we've talked about this at least 4 or 5 times. So this shouldn't be really new to you. It should be more reassuring you that you know what you're doing. Okay, I hope so anyway. All right, but if you don't, come talk to me. So this is kind of just a recap. Now, the audit process here it's a process that I urge you to go through, but like I have said in previous classes, everyone's brain works in a different way. This is the most logical flow that I can think of. This is the way I teach audit most of the time, but please do find a way that suits you and stick with it, okay? There's no obligation on you in terms of following a particular process. So the key thing I would say here is here's what I suggest doing. When you're given a scenario, when you're given a particular business situation, the first thing I urge you all to do is to read it and identify, okay, where are the risks? Where are the risks? So let's put an example to this. Is the risk, I'll do it in black, is the risk that they have overstated sales? Okay, is the risk that they will overstate revenue? Now, if that is indeed the case, go to step 2. Once you know what the risk is, you can link it to the accounts that are affected. So when revenue is an issue, what are the accounts affected other than revenue? What do you think? Yeah, here's the best way to do this. Think about the journal. Think about the journal and think, what's the other side of the journal? When you record revenue, you go debit, accounts receivable, credit, sales revenue. What does that mean? That means that if there's an issue with revenue, there's an issue with accounts receivable. That's the brother-sister account. So a lot of the time, this is what I keep on saying to you, don't disregard the importance of just your basic accounting debits and credits. Because if you trace it back to that, or I shouldn't say trace, if you vouch it back to that knowledge, that's going to help you solidify the rest of the gaps of your understanding. So in this case, the accounts will be revenue and accounts receivable. Now, what are the assertions? Ladies and gentlemen, in answering this question, it comes down to how can they do it? How can they overstate revenue? There are 3 ways that a business can overstate revenue. And given which way they do it, the assertion is different. Here we go. Number 1, they can overstate revenue by including fake sales. Ladies and gentlemen, what's the assertion there? Try again. If it's sales revenue. Occurrence, yes. So you know what? Let's do this in red. So if they overstate revenue by including fake sales, that's an occurrence issue. Another way they can do it is they include the sale. It really did happen, but instead of recording it at $100, they record it as $1,000. What's the assertion impacted? Write that down. The third way that they can overstate is by including real sales, but including sales that happen next year into this year. What's that? Well done. Do you see what I mean? So the question literally becomes, don't cut off. The question literally becomes, okay, how could they do this? Or how did they do this? And you go that way. You make the logical link that way. And again, you will be able to answer those questions very easily. You just have to think about it. You know what? Just while we're here, accounts payable. There's two main ways that they can impact. Actually, first of all, with accounts payable, are they more likely to overstate or understate? Understate. Because why? Yeah, but there's also liabilities, right? They want to show lower liabilities. So there's two ways you can do that. Number one, the one way that you can understate something is by not including it. Completeness is the issue. Number two, include it at the wrong number. So instead of it being $1,000, record it as 100, valuation and allocation. See what I mean? It's quite logical. And that's what I want you to be working on. Sit down and just think. Create a table for yourself and say, okay, if this is the particular account, what's the risk? Is it overstatement or understatement? Now, how could they have achieved that? Based off the answer to that one question, you would pick up all the assertions impacted. Do that. That's the best way for you to prepare because, guys, it's not about a piece of paper that you write up. It's about the way, the fact that you can think in a logical way to get there. That's going to be the key. That's my biggest advice to you. So as you go through this process, once you know what the assertion and what the account is, you then go and design your audit procedure, right? You've got to remember the procedure must match the assertion. When you're going forwards, when you're doing tracing, you could be checking for completeness. You could also be checking for accuracy, depending on what you're focusing on. Are you focusing on that it's there, or are you focusing on the dollar amount is right? What are you focusing on? That will help you in terms of the assertion link. Once you know what your test is, what's your population? Remember, your population is your starting point. Once you know your test, you already know your population. It's just the first thing you're looking at. From then, pick your sample. From that, execute your test and evaluate your results the way we discussed earlier. If it's controls test, evaluate your deviations. If it's a substantive test, evaluate your projected misstatement. All of these things are all linked. Ladies and gentlemen, as I said in my morning class, it's almost like for the past, 8 or 9 weeks, you've been working on a jigsaw puzzle. And the puzzle pieces are now coming together. That's it. You're not learning anything new now. You're just linking. Okay? You're just linking. Everything is part of the same process. And on that note, that is the reason why going forward, throughout the last few weeks, I'm sure you'll notice it's building. You need your prerequisite knowledge, like your assertion knowledge and your procedures knowledge, to then make the links going forward. All right? It's building. So let's see, how do you select the most appropriate audit procedure given the most appropriate audit procedure, how do you link it to the assertion? Here we go. Vouching is best used to test which assertion? What do you think? Vouching. You're going backwards. So which one is it? Existence. What other one? Try again. Occurrence. Now, someone just said valuation. Who said that? Yes. That is true if you're looking at the dollar amount. So it all comes down to, what are you focusing on? Are you focusing on the document just being there, or are you focusing on the dollar amount in the document, right? So I'm going to put that in, or valuation and allocation, or accuracy, depending on if it's transaction or balance sheet, right? Tracing is best used for which one? So you're tracing it all the way through from the beginning to the end to make sure it's there. What's that? What is it? Completeness. If you were checking the dollar amount, valuation allocation or accuracy. See what I mean? It's all about what your focus is. Recalculation is most commonly used for, we've done this a few times, accuracy and valuation and allocation. Final one, physical inspection. When you physically look at something, that gives you assurance over what? Good. Ladies and gentlemen, I'm going to say this one more time. Don't limit yourself to these. You need to sit and you need to practice. Best way to do it, look at different situations. Look at different accounts. Think about where's the risk and take it from there. Now let's try that out, okay? So I've got 4 assertions here and we're going to do it for sales. And there's a reason I've picked a wholesaler as our business. The reason is a wholesaler sells to other businesses. right? So there's actual sales invoices involved, there's actual sales orders involved. The reason I didn't do a retailer is because, guys, you know this. When you go to a retail store and you pay for something, there is no sales order unless it's a big item. There's no sales invoice, it's just a receipt. So this one is a longer process. That's why I picked it. So first one, occurrence. We want to test, so remember it's sales, we want to test that the sale really occurred. What's a procedure that we can do? Just give me one word. Sorry? Use your terminology. How can you test for occurrence? By the way, you just answered this in the last slide. Say it again. Vouching, right? Vouching. That one is going backwards and checking that it actually is real. You would vouch. Now, here's the thing. That's not enough to get you any marks. You need to be elaborating on how that test would work. So, for example, you could say, oh, you know what? Let me ask you this question. What's the starting point of a vouch test? Where are you starting, beginning or the end? What is the end? Ladies and gentlemen, before we go anywhere, that's your population. So the sales journals, that's your population, because that's where you're starting. So coming back to the procedure, you would vouch a sample of journals to the supporting documentation. Supporting documentation. Ladies and gentlemen, if you say that, I'm still going to give you 0. Okay? You need to be specific. What is the supporting documentation? Are you vouching it to what? The sales invoice? The delivery documentation? The original sales order? If so, what details are you matching along the way? Be specific. Be specific, okay? But remember, the population is your starting point. So in this case, it would be the sales journal. In terms of the sampling method, guys, up to you. Up to you. There's not much restriction here. You could go random selection. You could have gone interval or systematic selection. You could have gone haphazard. Up to you. The only real restriction you have when it comes to the sampling method is block. Block is specifically for cutoff, okay? Block doesn't make sense for anything else. If you're doing block testing of controls and you focus on the month of June, then all that's going to give you is comfort that it worked in June. What about the rest of the 11 months of the year? Okay? So you just have to be mindful with that particular one. Now, accuracy. Here's what I mean. Accuracy, to gain comfort over accuracy, you can actually just do the same process. But instead of looking at just the document, look at the dollar amount as you go. See what I mean? You could have performed the same test and ticked off on 2 assertions. Right? By vouching the journals to the supporting documentation, you gain comfort that it occurred, but if you check the dollar amounts while you do it, you've also checked that it's accurate. See what I mean? What's that word? What's that word? That's efficient, okay? That's what you will do. You want to do the test that will actually tick off on a number of different assertions as you, excuse me, as you go along. Now, if you didn't want to do that, if you wanted to do this on its own, recalculation is something we could potentially do. And you can recalculate the sales invoices, for example, and make sure that the totals were correct. Now, here's my question. If the process that you want to do is you want to recalculate the totals on the sales invoices, what's your population? Where are you starting? What are you looking at? The sales invoices. It wasn't a trick question. That was it. So that becomes your population, and you pick a sample of them. Guys, it's not difficult. Stop overcomplicating it in your minds. Where are you starting? Well, my test is I'm going to take a sample of sales invoices and I'm going to check the numbers right. Cool, that's your population. All right, and you take your sample from it. Sampling method, again, you could use the same combination or the same specific ones as you noted earlier. It's up to you, right? The only one, as I said, the only restriction is really block. Now, next one. Completeness, going the opposite direction, making sure that the transactions that should have been recorded have been included. What's the procedure that we would do? Good, trace. Now this is what I mean when I do this. Your population will literally come down to one question. Where are you starting the process? Because with tracing, you can start at any point. You can start at the very beginning, which is the sales order. You can start after that, which is the delivery documentation. You can start after that, which is the sales invoice. You can start anywhere along the process. And depending on where you do, your population will follow, right? but you need to decide where you want to commence that particular test. And that's what I mean. You and the person next to you could have a completely different test, but still be right. Okay, as long as it matches what it is you're trying to achieve. So you might trace, for example, the sales invoice to the journal. Okay? Now in doing that, then the sales invoice becomes the population, or the population sales invoices is the population. And again, you can do any of the sampling methods that we have previously noted. Cut off. As soon as we get here, ladies and gentlemen, what's the sampling method we use? What is it? Good. So that one, tick straight off the bat. And what you do here, as I noted to you earlier, is around that 30th of June or around that year-end mark, you take the last week or the last fortnight's worth of transactions and the first week or the first fortnight's set of transactions for the next year, and you vouch them back to the supporting documentation. Now, more importantly, it's often the invoice, because the date of the invoice will give you confirmation as to which period it should have been recorded. That's cut off. Because remember, the cut-off assertion is it recorded in the correct accounting period? Pretty straightforward. Once you see these connections, you're going to be fine. All right? Now, are there any questions on that? Okay. Yes? That's all right. Yep. Yep. Potentially, but you can still, as long as there's a number on the sales invoice, you're going to be able to find it. Okay? Because they need to keep track of it in a particular way. Even if they're filing it the way that you say, that per the date that it's been paid, there still needs to have a system where they can go back and find the ones that you want. Because we would often look at it from the number on the actual document rather than the date that it was paid. Yeah, so there have to be a process in place. Good question. Now, ladies and gentlemen, as I said earlier, I want to give you an example of a table you might want to start populating as part of your study material. Now, what have I done here? I've said, and it's basically following the steps we've already noted, figure out what's the risk. So if you're given a particular situation or you're given a particular account, ask yourself, okay, what's the risk with this account? Once you have the risk, you can link it to the assertions. Once you have that combination of account and assertion, find the procedure. This is a really good way for you to start thinking about different accounts. Notice the word I just said, different accounts. I know that the main example we keep on using in class is sales. Why? Because it's the easiest one for you to understand. Now that you get that, move away from it. Do this for accounts like accounts payable. Do it for things like COGS. Do it for like interest expense, things that are out of the ordinary. Because if you can wrap your head around those types of accounts and assertion combinations, you're in a really great position. It's a way of thinking, all right? You're not going to have one table that's going to answer all questions that can ever be given to you. No, but by populating a table like this, you've got the skills to answer any question that they can throw at you. And by they, I mean me, okay? You're going to be fine, but you need to work. After today, like I said, we have 3 weeks left. Talk to me if you have issues, but start preparing. Next week, we have a recap class, followed by the following week, which is the last topic, and then we have a revision week. And as I said earlier, an announcement will be coming out tomorrow morning regarding your tutorials as well, okay? Have a wonderful evening, everyone. I will see you next time. Well done.